America's housing market is sending signals that most people are not prepared for. It is unwinding rapidly, exposing the risks of a market built on leverage, speculation, and the assumption that global capital would flow in forever. Miami is number one on this list not because its decline is the most dramatic in percentage terms. It is number one because of what it represents, the clearest example of what happens when a housing market loses contact with economic reality and then is forced to return to it. From Austin to Miami, the pattern in 2026 is consistent and undeniable. Markets that surged the fastest during the boom are now correcting the hardest. Oversupply, elevated borrowing costs, investor retreat, and the end of pandemic-era migration have combined to create conditions that are reshaping American real estate city by city. This is not a temporary pause. The data does not support that conclusion. What is unfolding is a structural correction, and understanding where it is hitting hardest is no longer optional for anyone with money, property, or plans tied to American real estate. Stay informed. Stay ahead. If you found this analysis valuable, leave a comment below with your perspective. Share this video with anyone who needs to understand what is happening in the housing market right now. And subscribe to Expose the States, because the full story of America's housing market in 2026 is still being written. And we will be here to report every chapter. Clear, honest, data-backed reporting on America's housing market every week. Subscribe to Expose the States right now. Hit the bell so you never miss what's coming next. Number 10. Austin, Texas. Just 3 years ago, Austin was considered the hottest real estate market in the entire country. Tech companies relocated headquarters here. Remote workers flooded in from California and New York. Home prices surged nearly 68% between 2019 and 2022, pushing the median home price from approximately $340,000 to over $570,000. The city was celebrated as America's next great economic powerhouse. In 2026, that story has dramatically reversed. Austin's median home price has fallen to approximately $445,000. A decline of nearly 22% from its peak. Active listings have surged more than 180% year-over-year, flooding the market with supply that buyers simply are not absorbing. Homes are now sitting on the market for an average of 98 days. That compares to under 14 days during the peak frenzy of 2022. The core problem in Austin is structural oversupply. Developers built aggressively during the boom, delivering thousands of new units into a market that assumed population growth would continue indefinitely. When tech hiring slowed and remote work migration cooled, that assumption collapsed. Investors who purchased multiple properties expecting rapid appreciation are now liquidating. New construction continues adding supply. And first-time buyers, crushed by mortgage rates that remain elevated, simply cannot qualify. Austin is not just cooling. It is undergoing a significant structural correction that housing analysts now estimate could take 3 to 5 years to fully resolve. Number 9. Phoenix, Arizona. Phoenix became one of the defining boom markets of the pandemic era. Affordability relative to California, a growing job market, and aggressive investor activity pushed median home prices from roughly $280,000 in 2019 to nearly $480,000 by mid-2022, a surge of approximately 71% in under 3 years. By 2026, Phoenix is experiencing one of the sharpest corrections in its modern history. Median home prices have dropped to approximately $390,000, a decline of nearly 19% from the peak. Inventory has exploded by more than 210% year-over-year. Homes now sit on the market for an average of 110 days, compared to under 20 days during the height of the boom. The investor retreat is particularly visible here. During the boom, institutional buyers and small investors accounted for a significant share of Phoenix purchases. As returns collapsed and prices fell, those same investors began liquidating at scale, flooding listings faster than organic demand could absorb them. New construction compounds the problem. Builders who broke ground during the boom continue delivering finished homes into a market with shrinking buyer pools. The heat in Phoenix is no longer just meteorological. The housing market is burning through equity at a pace that is alarming long-term homeowners across the valley. Number 8. Memphis, Tennessee. Memphis does not appear on most national housing crash watch lists. That is precisely why it belongs on this one. During the pandemic boom, Memphis attracted significant investor attention due to its low entry prices and relatively high rental yields. Median home prices climbed from approximately $165,000 in 2019 to nearly $255,000 by mid-2022, an increase of roughly 55%. By 2026, those gains are rapidly disappearing. Median prices have fallen to approximately $205,000, erasing nearly $50,000 in value. Inventory has risen more than 150% year over year. Homes now sit on the market for over 95 days on average, and price reductions have become the norm rather than the exception. Memphis suffers from a compounding set of vulnerabilities. Its local economy lacks the diversification needed to sustain elevated prices. Wage growth has not kept pace with the price increases of the boom years. And investors who purchased rental properties are now finding that rental demand has softened, reducing yields and forcing liquidation. Memphis is a warning about what happens when speculative money flows into markets that lack the fundamental economic strength to support elevated valuations. Number 7. Boise, Idaho. Boise was one of the most dramatic boom stories in the entire country. Remote workers fleeing expensive coastal cities descended on this small Idaho city, pushing median home prices from approximately $310,000 in 2019 to nearly $545,000 by mid-2022, an extraordinary increase of 76% for a city of its size and economic base. By 2026, the reversal is severe. Median home prices have fallen to approximately $435,000, a decline of roughly 20%. Inventory has surged more than 190% year over year. Days on market now exceed 105 days on average, a stark contrast to the bidding wars that defined the market just years earlier. Boise's core vulnerability is clear. Its boom was driven almost entirely by migration from higher-cost markets. When remote work policies tightened and the cost advantage of relocating diminished, that migration flow slowed dramatically. The local economy, while growing, was never sized to support the price levels that out-of-state money created. Local wages remain significantly below what is needed to sustain current valuations, leaving the market dependent on continued outside investment that is no longer arriving. Number 6. Jacksonville, Florida. Jacksonville was positioned as Florida's safe bet. A large and diversified population base, relatively affordable entry prices, and steady job growth made it attractive to families, retirees, and investors alike. Between 2019 and 2022, median home prices surged roughly 74%, climbing from approximately $215,000 to nearly $375,000. By 2026, Jacksonville is no longer a safe bet. Active listings have surged more than 280%, swelling from roughly 5,000 homes to over 19,000 across Duval County. The median home price has already fallen close to 8% year over year, with sharper drops in suburban neighborhoods. A 4-bedroom home that sold for $400,000 at the peak now struggles to attract offers above $340,000, erasing $60,000 in household equity. Insurance costs are accelerating the downturn. Average annual premiums now exceed $5,200, up more than 45% in just 5 years. Property taxes near 1.7% continue squeezing affordability from every direction. Investors who once viewed Jacksonville as the next great Florida rental hub are now stuck with stagnant rents and mounting carrying costs, forcing an exit that is flooding the market with supply. Number 5. San Antonio, Texas. San Antonio built its housing boom on a foundation that seemed stable: military presence, healthcare sector growth, and steady in-migration from higher-cost Texas metros like Austin and Dallas. Between 2019 and 2022, median home prices climbed from approximately $230,000 to nearly $355,000, an increase of roughly 54%. By 2026, that foundation has cracked. Median prices have dropped to approximately $290,000, a decline of nearly 18% from the peak. Inventory has surged more than 165% year over year. Homes now sit unsold for an average of 100 days, and more than 35% of active listings have already seen at least one price reduction. The deeper problem in San Antonio is wage misalignment. Despite the price surge of the boom years, local median household incomes did not rise proportionally. As mortgage rates elevated the monthly cost of homeownership, a growing share of San Antonio residents found themselves priced out of the very market they lived in. Without strong external buyer demand to replace retreating investors, prices have only one direction to move. If this analysis is giving you a clearer picture of where America's housing market is truly heading, make sure you are subscribed to Expose the States. We publish weekly data-driven breakdowns that most outlets simply will not cover. Number 4. Cape Coral, Florida. Cape Coral represents one of the most extreme housing corrections anywhere in the United States in 2026. Between 2019 and 2022, median home prices surged roughly 82%, climbing from approximately $230,000 to more than $420,000 as retirees, remote workers, and investors rushed into Southwest Florida. By 2026, that rush has become a full-scale retreat. In some zip codes across Cape Coral, active listings have surged over 900%. Median prices have slipped back toward $338,000, wiping out nearly $82,000 in equity from peak levels. Canal front homes that sold for $450,000 at the peak now sit unsold near $360,000 despite repeated price reductions. Builders are offering $40,000 to $60,000 in incentives and still cannot move inventory. Insurance has made the situation nearly unsustainable for many owners. Post-storm premiums now exceed $9,000 annually for standard properties, while waterfront homes face bills pushing beyond $12,000. With nearly 11 months of inventory citywide, Cape Coral is no longer adjusting. It is unraveling, and the data suggests the bottom is not yet in sight. Number 3. Las Vegas, Nevada. Las Vegas embodies America's boom and bust cycle more clearly than almost any other city. During the pandemic surge, migration exploded, investors flooded in, and prices surged beyond any reasonable fundamental justification. By mid-2022, the median home price peaked near $480,000, fueled by speculation, leverage, and the belief that Las Vegas had permanently transformed into a major economic hub. By 2026, the collapse is severe. Median prices have fallen to approximately $368,000, a decline of nearly 23% from the peak. Inventory has more than doubled year over year. Homes now sit on the market for over 140 days, a clear signal of demand exhaustion. Investor liquidation dominates the market. Out-of-state buyers have retreated. New construction continues adding supply into a shrinking buyer pool. The entertainment capital of the world is confronting an uncomfortable economic truth. When speculative confidence disappears, markets built on that confidence do not simply slow, they contract sharply and correct to levels that reflect genuine local demand. In Las Vegas, that correction is still unfolding. Number 2. Tampa, Florida. Tampa was once held up as the model of post-pandemic American growth. Business relocations, population surges, and aggressive real estate investment transformed the city's national profile almost overnight. From 2019 to 2022, median home prices surged roughly 72%, climbing from approximately $250,000 to over $430,000. By 2026, the reversal has been equally dramatic. Inventory has exploded nearly 400% in just a few years, swelling from around 4,500 homes to more than 22,000 active listings across the metro. The median home price has already slipped back near $378,000, erasing more than $52,000 in equity from peak levels. Suburban homes that sold for $475,000 now sit unsold near $388,000. Downtown condos once trading at $600,000 have fallen toward $475,000, a correction approaching 21%. This analysis valuable? Leave a comment below with your perspective. Share this video with anyone who needs to understand what is happening in the housing market right now. And subscribe to Expose the States, because the full story of America's housing market in 2026 is still being written. And we will be here to report every chapter. Nearly half of all listings across Hillsborough and Pinellas counties have already been reduced at least once. Insurance premiums now average $7,500 annually. Property taxes near 2% and HOA fees exceeding $400 per month are crushing affordability from every direction. Tampa has flipped from boomtown to one of the clearest warning signs in American real estate. Number 1. Miami, Florida. Miami has long been the symbol of Florida's real estate ambitions. Fueled by foreign capital, luxury branding, and relentless speculative demand, the city attracted global attention and global money throughout the pandemic boom. From 2019 to 2022, median condo prices surged roughly 77%, climbing from approximately $350,000 to over $620,000. Developers raced to build skyward, selling units off-plan and projecting endless appreciation. By 2026, that narrative has collapsed under the weight of oversupply and soaring ownership costs. Active listings have exploded by nearly 280%, swelling from approximately 7,000 to more than 27,000 units across the metro. One-bedroom condos that sold for $550,000 during the peak now sit near $438,000, erasing over $112,000 in value. Luxury waterfront units in areas like Sunny Isles are seeing price cuts of $150,000 to $220,000 and still remain unsold for 200 days or more. Insurance has become a breaking point for ownership viability. Annual premiums now exceed $10,000 for many condo owners, with some facing $18,000 bills after new assessments. HOA fees in luxury towers regularly surpass $1,500 per month. With nearly 11 months of inventory citywide, Miami is no longer just cooling. It is unwinding rapidly, exposing the risks of a market built on leverage, speculation, and the assumption that global capital would flow in forever. Miami is number 1 on this list not because its decline is the most dramatic in percentage terms. It is number 1 because of what it represents, the clearest example of what happens when a housing market loses contact with economic reality and then is forced to return to it. From Austin to Miami, the pattern in 2026 is consistent and undeniable. Markets that surged the fastest during the boom are now correcting the hardest. Oversupply, elevated borrowing costs, investor retreat, and the end of pandemic-era migration have combined to create conditions that are reshaping American real estate city by city. This is not a temporary pause. The data does not support that conclusion. What is unfolding is a structural correction, and understanding where it is hitting hardest is no longer optional for anyone with money, property, or plans tied to American real estate. Stay informed. Stay ahead. If you found this analysis valuable, leave a comment below with your perspective. Share this video with anyone who needs to understand what is happening in the housing market right now. And subscribe to Expose the States, because the full story of America's housing market in 2026 is still being written. And we will be here to report every chapter.